price do I use? Do I use the high of the pivot or the low of the pivot? Well, the best way to answer that is to use the middle of the pivot. Use the middle of the balance area, so you don't use the high of a red candle in a green market or the low of a red candle in the green market. You just find the mid price of the balance. Find the mid price of that inflection area. Perfectly valid, because it's not an exact science. It's a rough idea where the market maker is going to deal. And when it ties in with other pivots, it becomes even more important to us. Here's a great example right here, which we were able to find a smashing trade from. There's a market buy coming in here. And then it creates this pivot here, right? So we get this balance area forming, and then we get a continuation. And that's what we're looking for, a continuation, right? And when we get the continuation here, we can see that the price, again, pivots here. Do you see how we get another pivot here from this pivot here? So we've drawn a red line in the middle of the pivots. What I'm now looking at is I'm now able to then assess that there should be a seller here. And if there is a seller there, and this is the important thing, if there is a seller there, I should be able to have a very high probability short sell here. Do you agree with that? Based on what we've covered already in the classroom. I should be having a very, very high probability short sell off of this level 2 liquidity right there at 58.5. Simple market maker math. So when the price rallies to that price there, and you can see that there's a seller comes in, I now know with a very, very high degree of certainty that the market maker model that's being used is going to aggressively sell the break above 58s, Tom, since you're the only one that's in the room. Do you agree with that, Tom? You happy with that? Well, yes and no, because when the price goes above 58s, I don't just automatically sell it. It's got to line up with a reason to sell it. It's got to line up because the market maker is going to be looking at that saying, well, I might not decide to do 58s, but in the face of it, they did 57s, 56 halves. So they must be expecting to sell at 58s. That's for sure, 100% certain now that that's what they're going to do if everything stacks up. So when the price then trades 58s here, you're now with almost 100% certainty that this is going to be a short sell. And with almost 100% certainty, it was a short sale. It's not a chump change trade, Tom. It's $1,000. If you followed the market maker math from earlier on in the session, it's $1,000 short sale from 58s to 48s. It's nuts, crazy, madness. But there we go. And we come all the way back into, guess where? A measured move at the bottom edge that we already knew about, a previous level, which we draw in the charts, as we always do. And when we put the inflection prices on the charts again, or we put balance areas on the charts and we do measured moves, all of a sudden the simple market maker math should make a lot of sense as usual. Is that not a surprise? Holy fecking moly. What the hell is even that? Crazy, right? Now, we don't know if it's going to bid off of that because we can see that there's a little inflection point here. So the fact that we've had an inflection point here a little bit earlier than we thought it was going to come in, you know, so you're starting to factor that into your thoughts as that little inflection point there comes in. But it's because we've obviously got a big kind of key level in the background here that's causing a little bit of a twist in the volatility in this area here. So we're getting this 50 twist area here. And obviously it just slows down into the measure move and bounces straight off the measure. It's spectacular. It's exactly as you would have expected. So we got the perfect sell. We got the evidence of the perfect sell. And whether we got the perfect sell from an order flow point of view or whether we got it from a value point of view, that's not what we're looking at here. We're looking at purely the market maker math behind this short sell. This idea of, this is why we get the 1, 2, 3 into a top edge. Does anybody not figure that out by now? This is the whole point about 1, 2, 3 accumulation into a top edge. Has anybody ever seen me doing this drawing? Anybody ever seen me doing this drawing before? For an accumulation trade? Well, that's the whole point of it, isn't it? That's the math behind that accumulation drawing. Yeah? It's not that difficult. We just build on the storylines. We build on the ideas. It's not an exact science because the market maker is going to, the market maker is going to react to how much buying is coming in, if any buying. They might have to spoof it. They might have to try and press it to get some liquidity into the high prices. They might have to do a lot of funny business to get a little bit of buyer at higher prices against a very short value, for example. But this is exactly what it looks like. In some respects, it's almost exactly the same as this. Does everybody agree that that there is the same? Pretty much same idea, isn't it? That's exactly the same idea there as this is here. Do you agree? It's almost exactly the same. Then we see the market maker process here, market maker process here, the slowdown into the high price, and the sell comes in. The slowdown into the low price, and the buy comes in. It's almost impossible not to see this crystal clear evidence of the market maker process into these little cheeky moves. Now, we might not recognize instantly the balance areas that are involved, but we can at least start working on those balance areas. Now, this one wasn't that difficult because it was just a prior swing low. With this prior swing low in the background when this thing formed, so there was always going to be a target idea, whereas this doesn't have anything in the background except for this prior swing high here, but there was a lot of prior swing low here. A lot of prior swing low here. There was a whole entire overnight session of swing low at this price. So this was a very, very clear idea. Here it's not as clear because we've only got that one reference price in the background. It's still a massive reference price in the background. Look at where all these big inflection trades have came from. Just look at where they all are. Straight line, a buy trade here. Straight line, a sell trade here. Straight line, a buy trade here. I mean, that's just ridiculous. That if you've got the ability to draw straight lines off of the major inflection points, you've got crazy opportunities to deal. And then simply by recognizing the ones that don't deal, give us the massive opportunity to deal off the measured move prices. So when this one here doesn't deal here, we then have an opportunity to consider that one there. When this one here doesn't go bid, we've got an opportunity to consider that one there. It's really not difficult. You see it? So when I see that balance coming down to here, it bounces, it breaks through. I should expect to see some buying coming in at this price, and I get some buying coming in at that price. Because I get buying coming in at that price, I have a very high probability there's going to be a buyer at that price. There it is. There's the high probability buyer at that price. Now, it happens very quickly. It's not exactly the smoothest, slowest move into that transition. It is what it is. We can only show you what is on the charts. We can't show you anything else. Beautiful, unbelievable quality of information. And you can see what's happened to the gold. Obviously, when it bounces off this is that inflection price area. So we know that this is going to be one of those areas that's going to have a decision in it. Just like any of these areas, like that area is going to have a decision in it. It went through it and it became the drive. This area is going to have a decision in it and it's came away from that price point. Use it or lose it. It's up to you. It is your choice.